Hi, I'm Richard Swaine, a Senior Associate in the Corporate team at Bristows. As part of my work here, I advise a number of growing technology companies when they're raising funding, in particular when that funding is by way of venture debt as opposed to equity. Venture debt is a small but growing element of the UK venture investment picture. It's been a feature of the US market, particularly for life sciences companies, for some time. And we're now seeing more UK-based providers lending to technology companies, particularly as they get more comfortable providing debt to pre-revenue companies whose main assets are intellectual property. Venture debt providers are usually looking to invest in companies that have passed seed stage or a Series A round, and this type of investment is often referred to as being between the rounds, and is used to bridge a funding gap where the current shareholders aren't keen to incur further dilution. There's also a growing market for asset-based or invoice financing for growth stage companies, particularly where they've started to become revenue generating, but that sort of facility is outside the term of this item. So what are the features of venture financing from the borrower's perspective? The commercial terms of all loans will be slightly dependent on the borrower's needs, credit, and often the standard approach taken by the funder. But here are the main features that we focus on when reviewing the term sheets for clients. The investment generally takes the form of a term loan, usually 2 to 4 years in length, with limited period during which the borrower can draw down, at the beginning of the period or in agreed windows. As with all debt, these facilities are interest-bearing, usually at a higher rate than retail bank lending rate, and we've seen rates as high as 15% and more, although a fixed rate of between 6 and 8% per annum is more normal. Timing and frequency of payments is one of the terms that are generally negotiable. Loans are repayable in regular instalments or at the end of the term. The loan will be payable in full if there's an exit during the term, and it's generally permitted for the borrower to repay prior to the term end date. Repayment is usually accompanied by a fee, and there are two types of end-term fee: a simple percentage of the amount borrowed, or, if linked to an exit, a fee calculated by reference to the sale price. These second types of fees are sometimes called synthetic equity, as they allow the lender to borrow from a growth upside without having shares in the company. Fees are a general feature of venture debt investments. There's a fee on drawdown of between 1 and 2%, and sometimes an ongoing annual fee and monitoring fees. The funders also usually expect borrowers to pay their legal fees for the loan and variations during the term. The fees, along with interest charged, can make these loans an expensive form of investment, although becoming more competitive as more providers enter the market. It's really important to work through the term sheet carefully and establish what fees are payable in connection with the lending, and work those into your working capital calculations along with the interest elements. This will help ensure that you get a clear picture of the financial commitment and how affordable the loan will be. Although there's a trend towards covenant-light facilities, borrowers also need to carefully consider what covenants are being requested by the lender. These take the three forms: financial, business and information covenants. Financial covenants linked to the borrower's performance will need to be carefully considered alongside the business plan to reduce the chance of a loan default. Business-related covenants can limit the borrower's ability to raise further debt or equity financing without lender consent, and these have to be carefully considered as they can impede further growth at key stages. Information covenants also need to be considered to ensure that the borrower isn't taking on onerous reporting obligations. Finally, borrowers often require the borrower to provide security over its assets. This means the target has to accept restrictions on dealing with and disposing its assets, and the security package generally be over all of its business and assets. So that's a summary of the main terms, but there are other things that need consideration. Like any other investment, taking on venture debt is likely to require consent over your shareholders' agreement. It's also important to consider existing lenders. If you have bank lending more than an overdraft, you will almost certainly require the bank's consent to take on further debt. If you have shareholder lending, the venture debt provider is likely to want those lenders to subordinate, i.e. agree not to be repaid in full until the venture debt provider's loan has been repaid. Negotiation on this type of element of the deal can add significant time and cost, and it's better to get these started as soon as the term sheet's been signed. Whilst venture debt is much lighter in terms of due diligence compared to other forms of investment, lenders will want the borrower to provide warranties in respect of its business. If these are breached, the loan can be called in. So it's important that before taking on venture debt, you know that you'll be able to comply with warranties, and so this usually requires a general amount of tidying up, even if that tidying up is not shown to the funder. So that's a whistle-stop tour through venture debt. If you'd like more information or would like to know how we can help if you're considering taking on venture debt financing, then please do get in touch.